I'm Joseph Kim. In this week's Video Insights, I will provide some thoughts on the outlook for major miners, BHP and Rio Tinto, in 2020. My thoughts will help explain part of the reason for the Montgomery Fund's decision not to invest in either company at the current share price. Generally speaking, 2019 was a positive year for the miners, with a total return for the resources index of 26%, better than the broader ASX 300 index at 24%. Most of this was powered by the big Australian, with BHP posting a total return of 25%, while Rio Tinto's performance was even more impressive, with a total return of 41%. In hindsight, most of the performance can be attributed to the unexpected strength in iron ore over 2019. This was a result of Vale's tailings dam tragedy, which resulted in a supply shock of between 3 to 5% of global seaborne supply. China's stimulus efforts to counteract the negative impact of the trade war with the US also helped, as infrastructure and property are intensive users of steel. As a result, the high in iron ore price has enabled both BHP and Rio Tinto to pay out record dividends as they follow through on their commitment from 2016 to return more cash to shareholders. Should iron ore remain stable, shareholders can expect further strong dividends coming from the majors. So what about 2020? For a start, it's unlikely this year we'll see a repeat of the tail risk supply event that occurred in January last year. While it is impossible to predict tail risk events, it's possible we may have seen one already on the demand side with the coronavirus that will most certainly impact activity in the first half of 2020. With China being by far the most dominant consumer of iron ore at over 70% of global supply, this may negatively impact prices for at least the short to medium term. With commodity prices unlikely to be a tailwind from current levels, the miners would need to rely on production growth to maintain earnings. However, while the focus on capital allocation and supply discipline has helped re-rate the sector and generated significant shareholder returns, the result is a subdued production growth profile for both BHP and Rio Tinto. This is demonstrated in the following charts, with forecasts for production at BHP and Rio broadly flat on a copper equivalent basis over the next 3 to 4 years. We believe that without production growth, a positive outlook on commodity prices, especially iron ore, is required to invest in the majors for a favourable risk-reward profile at the current share price, even with a strong dividends forecast for the February reporting season. Given the unknown impact of the coronavirus in terms of economic activity and China's status as the dominant consumer of most commodities, including iron ore, we remain somewhat cautious on the near-term outlook for the sector. That's it for this week's video update, and remember to follow us on Facebook and Twitter.